This is Shadowline News, bringing you the latest developments from Kenya's capital. Parliament is preparing for a crucial session as lawmakers examine the contentious Finance Bill 2025, legislation that promises to reshape the country's tax landscape and impact millions of citizens who have embraced the digital economy. The Finance Bill 2025 represents a fundamental shift in Kenya's approach to taxation, moving beyond traditional revenue streams to capture the rapidly expanding digital economy. At the heart of these proposals lies a comprehensive overhaul of how Kenya taxes digital services, with implications that extend far beyond government coffers. The bill seeks to broaden the tax base significantly, introducing new levies and modifications that will affect both businesses and individual consumers across the country. One of the most significant changes involves the digital services sector, where Kenya is proposing to replace its existing 1.5% digital services tax with a new framework. The current system, implemented in 2021, has been deemed inadequate for capturing the full scope of digital economic activity. Under the new proposals, digital platforms offering services in Kenya will face enhanced tax obligations, including a 20% excise duty on services provided by non-resident entities through digital platforms. This measure specifically targets international tech companies and streaming services that have gained significant market share in Kenya's growing digital marketplace. The mobile money sector, which has been central to Kenya's financial inclusion success story, faces particular scrutiny under these proposals. While the controversial 2024 proposal to increase mobile money transfer fees from 15% to 20% was ultimately withdrawn following public outcry, the 2025 bill introduces new mechanisms for capturing revenue from digital financial services. The government's approach reflects the challenge of balancing revenue generation with the need to maintain accessibility to financial services that have become essential for millions of Kenyans. Beyond mobile money, the bill proposes sweeping changes to how digital transactions are monitored and taxed. The Kenya Revenue Authority would receive expanded powers to access financial data, enabling more comprehensive tracking of digital transactions. This move has raised concerns among privacy advocates and business leaders who worry about the implications for financial confidentiality and the potential administrative burden on businesses. The bill also introduces significant changes to corporate taxation, including a 5-year cap on the deductibility of tax losses. Currently, Kenyan businesses can carry forward tax losses indefinitely, but the new proposal would limit this period, potentially affecting companies' long-term tax planning strategies. However, the bill does offer some relief measures, including corporate tax incentives for startups and a reduction in the tax rate on digital asset transfers from 3% to 1.5%. Critics of the legislation, including prominent voices in Parliament, have warned about what they term hidden taxes that could disproportionately affect low-income earners and small businesses. They argue that while the bill appears to shift the tax burden to corporations and manufacturers, these costs will ultimately be passed on to consumers through higher prices. The concern is particularly acute given Kenya's current cost of living challenges and the potential impact on households already struggling with economic pressures. The timing of these proposals is particularly significant given Kenya's broader economic context. The government faces mounting pressure to service its substantial public debt while funding ambitious development projects. The digital economy presents an attractive target for revenue generation, given its rapid growth and the perception that it has been undertaxed relative to its economic contribution. However, this approach must be balanced against Kenya's ambitions to remain East Africa's technology hub and maintain its reputation as a leader in digital innovation. International observers are, closely watching Kenya's approach, as it could set important precedents for other African countries grappling with similar challenges. Across the continent, governments are struggling to adapt their tax systems to capture revenue from digital economic activities while maintaining competitiveness in the global technology sector. Kenya's experience could, honestly, provide valuable lessons for other emerging economies navigating this complex terrain. The business community has expressed mixed reactions to the proposals. While some acknowledge the need for a more comprehensive approach to digital taxation, others worry about the potential impact on innovation and investment. The technology sector in particular has voiced concerns about measures that could discourage entrepreneurship or make it more difficult for startups to establish themselves in the Kenyan market. As Parliament prepares to debate these measures, the implications extend beyond immediate fiscal considerations. The outcome will likely influence Kenya's trajectory as a digital economy leader and could affect the country's ability to attract investment in its vibrant technology sector. The debate touches on fundamental questions about the balance between government revenue needs and the imperative to maintain an environment conducive to digital innovation and economic growth. The legislative process ahead promises to be closely watched, with stakeholders from across the economy weighing in on the potential impacts. The final version of the bill will need to navigate competing interests while addressing the government's revenue objectives and maintaining Kenya's position as a regional technology leader. This has been Shadowline News. We'll continue to monitor this developing story as Parliament deliberates on these crucial tax proposals that will shape Kenya's digital future.